Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our April monthly market update. So there's clearly a lot going on. We'll try to go into some of those things and how they're impacting financial markets. I won't add much to what is already known about the Russia-Ukraine conflict that's now going on 6 weeks, and its impact to not just commodities, but the human tragedy. And we ultimately don't know where it leads. So it's definitely an added level of geopolitical risk. It's part of the reason I'll talk about this as we discuss rebalancing, that we recently reduced international exposure. Again, I'll speak more about that momentarily. So events like these, they're always terrible as we're going through them. And I've shared this before, but it's interesting to look at roughly 50 years worth of history and what's happened following all of these events, and then how long it takes for markets to get to prior highs. So I won't go through all of them, but one of them that stuck out to me is 9/11. Markets sold off for 6 days, and within 15 trading days, we're back to prior highs. So I bring this up just to say that over the 50 years worth of these events, that it's always very loud during a few trading days after these events, but markets tend to get back to prior highs relatively quickly. Another interesting component is kind of where satisfaction is now with a lot going on. As you might expect, satisfaction recently measured in February of this year is pretty low. What's interesting is that the median return over the next 12 months, when satisfaction is at this level, minus 34, is on average up 15%. Talking about jobs, the March job reports was good. Over 400,000 jobs added, 3.6 unemployment, wages picking up at about 5.5% annualized, still under inflation, but overall a good jobs number. So we're going to talk in the next few minutes about the Fed and kind of what they're trying to target with inflation, keeping in mind the Fed has dual mandates of price stability and full employment. What they're trying to do is to park in a very tight spot here, which is they're trying to curb inflation, which we'll talk about in a second, while not leading the economy into a recession. You'll see inflation is running hot. You'll see kind of where it's been since March of 21 through February, and it's the kind of the headline number is just under 8. And these are the components. So what the Fed is trying to do started with the 25 basis point increase to rates last month, likely 50 basis points in May. And another thing that you saw an announcement just this week, a reduction of their balance sheet of 60 billion and 35 billion in terms of treasuries and mortgages that won't be renewed. So again, the Fed is trying to park in a very tight parking space of reducing inflation risk on the one hand, but not sufficiently slowing the economy such that we go into a recession. You've heard a lot of talk about inverted yield curve, which is basically a scenario where the 2-year is trading higher than the 10-year in terms of yield. We have seen that happen recently. It does tend to be a recession predictor, although there's a huge lag time between when the yield curve inverts and when a recession actually happens, on average about 1.5 years later. So there's a lot of gap in between those periods of time. And interestingly, the performance when the yield curve is inverted going back to the mid-70s, asset returns while the yield curve is inverted is high. And in fact, for stocks, they're best when the yield curve is flat to below 1. I will say at the time of this recording, the yield curve isn't inverted anymore. So it was a very short period of time, and it was very flat yield curve inversion. Whether it predicts the next recession, we'll have to see. Just keep in mind that there's a big lag time in between when the yield curve inverts and when the recessions historically, the yield curve inversion have predicted when they actually materialize. We have seen volatility pick up. The low point in markets this year was down 13. We've cut that about in half. But this is a chart that we share frequently that shows that the average intra-year decline over the last 4 decades is an annual drop of down 14%. Intra-year, even though 32 of this 42 years was up. And looking at things over an even longer period of time, we look at the S&P since 1926, you've got 71 positive years and 25 negative. The positive years average 21, the negative years average 13. I bring all this up to say that these negative years and their average returns are never fun, but they're outweighed by an almost 3-to-1 basis, the positive years, and almost 2-to-1 average return on the upside versus the average return on the downside. So we are rebalancing. You'll see this happen within the last day or two. Principally, this is an intra-quarter rebalance where primarily we reduced international exposure because of greater geopolitical risk. We rebalance at least quarter and intra-quarter as circumstances dictate, and we thought that was warranted during this quarter. So one of the things we'd ask from you is to contact us if you have any questions. Please leave no question unanswered. We're here to help and to serve you. So with that in mind, we'll close. We try to keep these relatively brief and cover the high points of the market. This is no replacement for us talking to you about how all these items affect you personally. So please reach out to us. Until we see you again, stay well and take care.